Welcome back. So, friends, we look at the markets in the week ahead, beginning August 7, 2023. We look at the global markets in this video, see where they are headed from here. Friends, there are lots of positive that are built in the market at this point of time, but there are a lot of negatives as well. What has happened this year has been a relief rally, a rally that has come about as a result of lower inflation. And this whole thing has led to expectations that the US Federal Reserve will cut the interest rates, and this will reverberate across the world. So many other central banks will also follow the same direction. That has been the basic hypothesis on the basis of which this market rally has gone on so long. We are seeing the early signs of dithering in this rally. We seen it last week. On the positive side, the employee cost measure ECI has come much below expectations. There is a little slowing down in the jobs market that the latest jobs data is indicating. The fears of money supply going down are no longer there as much. In fact, the first half, you found that a world economic growth, and particularly in the United States, growing by more than 2% was much higher than most people have anticipated. All this points to, whereas inflation is going down, the economy is stronger than most people have anticipated. Housing data has been a lagging indicator, yet it has provided now more clues to the US Federal Reserve by using forward-looking multiples as to what lies ahead in the markets ahead and how they can tune in their inflation expectations, their interest rate hike accordingly based on the future-looking data rather than the past-looking data. Valuations are a concern, no doubt. S&P at 20 times earnings is appearing to be a little rich. However, do not forget the fact that during the dot-com bubble, the S&P multiples were closer to 30 and the interest rates were much higher at that point of time. So that all has supported, and there is that little zinc left in the rally that can take it little more. However, there are many things that you need to understand that they will come to hound as further upward momentum in the markets continues. Among the biggest things that can come to play is that the markets are now getting in almost all the bears converted into bulls. So an element you find that now there are people who are talking of a zero probability of recession. And as history has indicated, whenever you find in a scenario where the bulls have converted the bears have converted themselves into bulls, that's a time to be cautious. Second part is that the earnings expansion has been a major part of the rise in the markets as of now. Now, margins have stabilized, but how long this earnings growth, which is less than just a multiple expansion, let me tell you that there are two ways in which the stock valuations can go up. One is by multiple expansion, another is by earnings expansion. Right now, multiple expansion is more than the earnings expansion. Earnings expansion could go up a little more. They have risen, they have done better. Like there was a lot of lack of confidence in the prior 2 quarters, and now it's beginning to change. Yet you find that different sectors are behaving differently. For example, you find that energy and materials, there has been a little bit of negativity. On the other hand, you have the industrials, the consumer discretionary and communication services, which have been doing well in many countries, such as the United States. We have also had globally the benefit of Europe coming out of the scare of a recession. So that's helping the European markets. As far as the other markets like China concerned, China is now reopening, and naturally, therefore, that is also getting benefited substantially. And we have the earnings positive turning to be helpful to Japan and Latin America. There are cyclical and structural changes which are helping countries such as Mexico and India. All this augurs well for the global stock markets. Yet do not forget the fact that something like a downgrade which happened by Fitch just last week, and something can come again and hound the markets. Now, why is the rating agencies so important in this market? Rating agencies look at the overall macroeconomic perspective, and they really have a very important role to play in the markets. As you can see, US markets 3 days in a row fell after the Fitch downgrade. There could be more downgrades coming in. The nature of the economy is such that interest rates being such a high factor at this point of time, the true impact is not being felt as yet. Every time the markets have fallen as a result of some sort of a catastrophic event, we recently saw that the Federal Reserve had to come out, the US Treasury had to come out in the midst of regional banking crisis in March 2023, come to bailout. So that has led to more expansion of money and more infusion of liquidity rather than withdrawal of liquidity. Now, how long can this go on, friends, right? It's another catastrophe, and you may find they come out once again, but there may be a point of time where the moral hazard can also come into the picture, and this, I think, is not too far off. There will be a situation where you may hear that one of these sectors, such as the commercial real estate in the United States, suddenly getting into deeper trouble. The lenders to the commercial real estate could also begin to withdraw. You could see the central banks across the world beginning to feel the jitters. The expansion in the economy may not be commensurate with the downtrend in inflation. So that the hope that economic expansion and a Goldilocks scenario that is getting built may not come about as perfectly as planned. You may see that many companies begin to struggle at the higher end because there is, after all, what is called an inflection point. And you will find that there's an inflection point is a point where beyond which any further hike in the interest rates is beginning to trouble somebody. Are companies in the corporate sector that can be tremendously detrimental to their earnings and their earnings announcements. So all this, I think, is something that is leading the way to an event and a situation where the market can turn down sooner than what you anticipate. It is still on a recovery path. It's still on some steam left in the rally. But I would say that do not forget the fact that a downturn is also nearing much faster than you can think. To get to know when the markets and where the markets and how severely they can turn from here, please to be a part of our Prime or Prime Plus groups for the US markets. For the Indian markets, you can join our Premium or Premium Plus and be a beneficiary of all of our knowledge as to where the markets will turn, how much longer this rally can last and sustain, and where is the big turning point ahead for global stock markets. The number to get in touch, 9820861044. You can also email us alternatively at globalmoneyinvestor@gmail.com. globalmoneyinvestor@gmail.com. Enjoy the rally while it lasts. But remember, the turn is nearing very fast, faster than you think. There are no technical indicators, no crossovers will tell you. We, with our algorithms and experience of over 35 years, will tell you much in advance before others do and give you that competitive advantage. But you definitely need to be a part of all of our any of our Telegram channels. Feel free and love to exchange more information with you. Happy investing. Take care and have a great investing week ahead. Take care. Bye-bye.